Standing Scholar discussion for the Lehman Trilogy. Joining us tonight, we have Eric Hilt. And I'd love to introduce our guest to you, and then I will explain a little bit about how tonight's it's going to be structured. Eric Hilt is the professor of economics at Wellesley College and a research associate of the National Bureau of Economic Research in Cambridge, Massachusetts. He received his PhD in economics from Columbia University and has been a visiting professor at Yale University. He is an economic historian whose works focus on questions related to the development of American financial markets, early financial crises, the role of slavery in the economy, and the political economy of the Gilded Age. His research has been published in the leading journals of the field of economics, business history, law, and economic history. And Eric is currently the co-editor of the Journal of Economic History. So welcome, Eric. We are so glad to have you here tonight, and I'm so excited to jump into this conversation with you. So for tonight, I will be facilitating a number of questions, and you as the audience are also welcome to join in. There is a Q&A function in this Zoom webinar. You can find it at the bottom of your screen. And if a question comes up for you as we're talking, feel free to put it in the Q&A section, and we will address it, whether it will be in the chat or whether I'll verbalize it. So thank you so much for joining us again. And Eric, it's wonderful to meet you.
Thanks very much for having me.
Yeah. So just to get us started, I know you have some familiarity with the Lehman Trilogy because you've heard the audiobook of the original novel. And you would note that the story takes a degree of poetic license in covering the history of the Lehmans. Could you share more about how you experienced that poetic license and what you know of the Lehmans' actual immigration story?
Well, in some respects, the story, in a way, exaggerates the significance of the Lehman Brothers for the economy. It implies that they invented their role as middlemen in the cotton market. And they may have been innovators in some respects, but the cotton commission merchants, cotton brokers, they were very important parts of the economy. And I think it's an exaggeration to say that they were unique or invented that role in some way. Another issue that I think you have to keep in mind with this story, if you're thinking about the economy more broadly, is that you're seeing the history of an important part of the American economic evolution through the lens of a single, highly successful and largely unrepresentative firm that was operating in a very narrow part of the economy. So there were hundreds, if not thousands, of firms that tried to do what Lehman Brothers did and failed. Right? They got wiped out in a financial crisis, or they didn't have the talent to do it, or they just didn't have the luck to be in the right place at the right time. That's an important part of the American story, and that's not part of this story. That's to say nothing of the small farmers and later factory workers who were the majority of the American population. So it's a fascinating view into American financial and economic history, but it's a very sort of narrow and specialized one. You have to keep that broader context in mind when you see it. Likewise, their immigration story is not typical. Of course, immigration is a very important part of American economic life and American culture. Henry Lehman's decision to move to the South was not typical of American immigrants. So most immigrants into the United States preferred to move, initially to the Northeast and later to the West, and not to the South. They perceived the South as being a place that was, one way to think about it would be just there's fewer opportunities to outsiders. The South was seen at the time, I think correctly, as a place that was sort of dominated by wealthy slaveholders, and the society was sort of built around that, and it therefore lacked a good school system, much urbanization. It wasn't very dynamic and innovative in most respects. And someone looking to start off, here, start a new life, initially as a farmer with, other ambitions, would probably believe that going to, Iowa rather than Alabama was a more promising choice. So those issues have to be kept in mind. There's a few anachronisms in the play as well, but I don't think they're that important for the story.
Wonderful. That's really interesting. Do you have a sense of why the Lehmans might have chosen Alabama? Like, what are the pull factors of Alabama?
Well, so Henry Lehman and later his brothers, were initially peddlers looking to sell goods who later found ways to advance into more complex and sophisticated but related businesses. I think that at the time, the slave economies of what we might think of as the newer states of the South, like Alabama and Mississippi, they were relatively recently established. So they joined the United States in like the late 1810s. They're very, very rapidly growing, and cotton is booming. And so it is a place where a merchant, it probably also, is not super well populated yet. There's probably less competition for people there. So if you didn't want to become a farmer and you wanted to become a merchant, it was probably a place where the market for your services was growing very rapidly, and you didn't face a lot of competition. So if you could tough it out in the confines of this institutional environment that wasn't very hospitable to outsiders, you could probably do quite well in this sort of rapidly growing place.
Absolutely. And it's interesting that you bring up the way the slave trade had been functioning at the time, because the play itself, Lehman Trilogy, it makes a passing mention of the way Henry, Emanuel, and Maya Lehman were complicit in that slave trade. And it was most notably in the way they built their business around cotton. But it doesn't really engage with the implication of that complicity. So to your knowledge, I was wondering, what do you think the history of American slavery, how does it tie into our modern financial reality?
Well, the first place to start to think about that is with cotton. Cotton was the most important export product of the United States in the 19th century. That was hugely important for earning hard currency, which was the basis of our banking system at the time, through export. New York quickly grew to become the center of the cotton business, and New York's role in financing the cotton business is what helped establish its preeminence in financial markets. It wasn't the only factor, but it was important behind it. So in a superficial sense, slave-grown cotton helped fuel the rise of Wall Street and the sort of banking complexes around that in New York. It's just a very, very important part of the American economy at the time. There are deeper connections that are a little bit more distant historically and more indirect, but I think it's worth mentioning. The colonies that became the United States were founded as part, as you know, of these great European trading empires, for which the trade in slaves and the use of enslaved labor were absolutely central, right? So slavery was present in all the North American colonies. It was very, very common for, wealthy merchants in Boston and New York to have enslaved people in their houses as servants. Typically, artisans used them as their workforce at the time in the 18th century. So it's not just about cotton in the American South. It's sort of deeper than that. And there's sort of a deep institutional connection to that. It is interesting to me that the Lehmans owned enslaved people. I don't think they had any involvement in the slave trade per se, so involvement in like buying and selling people, but they certainly purchased some. I think this was probably unusual for immigrant merchants in the South, but certainly not unheard of. I interpret it as a sign that they were just very firmly established in Alabama, and how like deeply they had become assimilated in Southern culture. So, in a slave society, the elite own enslaved people. It's part of the fabric of that kind of society. It's also worth mentioning enslaved people were extraordinarily expensive. So the Lehman family was taking substantial capital and turning it into these essentially consumption goods, like very, very expensive presumably household laborers who would do the cooking and the laundry and service clerks and whatnot, in addition to probably raising their children as well, right? So they're living very, very extravagantly in a way that would not have been out of place in like New York City in 1780, but by that time slavery was gone from the North. But in the 1850s, that was the way the elite of Alabama and Mississippi and Virginia and Georgia and Louisiana, that's the way that they lived. And the Lehman Brothers were part of that sort of slave society.
Certainly. And I also want to remind our audience that if any questions are coming up for you, you are welcome to put them into the Q&A function at the bottom of your Zoom screen. We'd love to hear from you. But Eric, this was really, really interesting because from what you're saying, the Lehman Brothers, the original three Lehman Brothers, were part of the elite, therefore, of Alabama.
Yes.
And the other thing that I'm seeing is happening is that the Lehman Brothers as a firm was starting to really come into its own and experiencing significant growth. And at the same time, you had also mentioned in your earlier response to one of my questions that there had been some challenges in the landscape as they navigated it. And not every firm would have achieved the same kind of success that the Lehman Brothers did. So could you speak a little bit more about the social and economic landscape that the firm would have been navigating during this period?
Well, so I think a defining characteristic of the Lehman family is that they were Jewish, right? So their religious identity is an absolutely inextricable part of their economic identity and their social identity. And anti-Semitism was very widespread and firmly ingrained part of American culture, both then and now, but probably to a much greater extent then. And it would have shaped the evolution of the Lehman Brothers firm. So although they could be quite successful, Jewish firms, and they were always known to be Jewish and sort of self-consciously so, they were separate from other firms in a social sense. So they would interact with other firms economically. They would, transact with one another, join together in particular ventures, something like this. But socially, they were entirely separate. And part of that had to do with the fact that businesses like Lehman Brothers, this is the sort of dominant form of business organization at the time in the 19th century, they were organized as family partnerships. So the family members would be the partners of the firm. These firms, as they grew, would admit outsiders, non-family members, but often, these outsiders who would join the firm would try to marry the daughters of one of the partners so that a family tie, if it wasn't present, would be created, right? But so the fact that the firm's identity was so closely tied to the family that created the firm, that founded the firm, and the fact that Jews were, socially separate from Gentiles, from non-Jews, meant that, that the firm itself was also separate from other firms. And so this becomes really important in the late 19th, it's important throughout the history of the firm, but it becomes really vivid in the late 19th century as Lehman Brothers is established as, an elite investment bank in New York, like the capital of American finance. So there's many elite Jewish investment banks in New York at the time. One of the largest and most successful is a firm that would, in the 20th century merge with Lehman Brothers called Kuhn Loeb and Company. But there's also, Seligman's and many others, Spire and Company. So they're in this sort of wealthy, very, very rarefied Jewish social circle in New York that included some of the wealthiest people in the United States, but was completely separate from the other and sort of more dominant part of New York's elite financial world, which was inhabited by, the partners of firms like J.P. Morgan and Company, typically WASPy firms that did not socialize with Jewish firms at all. So this posed problems for the Jewish firms. They were, of course, not like formally excluded from transactions. They had many like really important corporate clients who were very important in business, but a lot of business was done. There's a social component to business. A lot of business was done at that time in elite social clubs that are very exclusive. So clubs with names like the Union League Club and so on. You had to be, from a very distinguished family to be admitted to that club. And of course, they excluded Jews categorically. The way that sort of elite Jewish families, elite Jewish firms responded to that in part was by founding their own elite Jewish social clubs. So there's in New York the Harmony Club, which admits wealthy, prominent Jews, and by the way, only Jews who are descended from German Jews. So they thought of themselves as being too exclusive for later Jewish immigrants from Eastern Europe and so on. But in any case, so the Lehman Brothers they have to exist within this very complex social environment where they're excluded from some parts of the business world, but they're very talented and very successful, and they're able to compete in other parts. The one other thing I'll mention about the elite Jewish families in New York is that they tended to intermarry very, very frequently. So this sort of rarefied group of a small number of very, very wealthy New York families, they reproduced their status through intermarriage, and they were not particularly open to newcomers joining their social circles, unless those newcomers made tremendous amounts of wealth, they could probably eventually join. So briefly about the economic environment, Lehman Brothers were very clever and very opportunistic, and moved into more profitable businesses as they were able to. So they start as peddlers, and they eventually become sort of storekeepers, like selling what would have then been called dry goods. And a business like that does a lot of business on credit, forms lots of relationships with local customers, but they face a lot of competition, and they don't make tremendous profits. It's not a business that can make you tremendously rich unless you can expand massively. And rather than try to expand, what they do is they move into more profitable businesses, namely the cotton brokerage and cotton factorage businesses. So that's a business that requires a lot more capital and a lot more sophisticated knowledge, but it's the backbone of cotton production. So they facilitate the flow of credit to the producers, and in exchange, they facilitate the sale of their goods, often by charging a commission on the sale. So the cotton business is more difficult, more challenging, but also more profitable. But the cotton business itself is a business where credit plays an important role. They're, as I said, like essentially floating capital to producers and earning money on interest, and that enables them to become more specialists in finance, and eventually they just enter banking exclusively. That's a progression that a lot of investment banks follow. They start out in some kind of mercantile business or some kind of merchant business, and as they become successful and they become capable of specializing in finance, they do that because it's more profitable, and they have the experience and knowledge they gain gives them advantages, enables them to be competitive. So that's my long-winded answer to your question.
That's wonderful. Thank you. I did pick up from the first part of your answer that you had mentioned that family ties were really important in sustaining a lot of these businesses. And the Lehman Trilogy itself emphasizes the importance of family ties throughout, because it tracks how the leadership was passed from Lehman to Lehman. And for those who have not yet seen the play, in the final act, it almost glosses over the final transition out of the family. I would be curious to know if you personally think that these kinds of family ties were a really important ingredient to the early success of these kinds of firms.
Yes, I think that they almost certainly were. So in finance, it's an inherently risky business, where people need to be able to act using other people's money, and there's a fair amount of trust involved, and having family connections to the other people who are putting your money at risk is very helpful and very important. The investment banking business evolves away from being family-centered in the late 20th century. And the reason that happens, this is also probably part of the reason why Lehman Brothers became less of a family firm, is that the business shifted to a different model where sort of personal connections and the knowledge of specific individuals became less important, and what economists call capital, in the form of giant computers and databases capable of organizing information relating to millions of customers, for example, they became more important. And so the business became less about like this very, very specific skills of individuals, although skillful individuals are always essential to the business, and more about like acquiring like massive amounts of capital and deploying these new technologies to do things more efficiently and compete in markets as they evolved. So the role of families changed. It happened around, the 70s and 80s in the US, and that's exactly the time when Lehman Brothers, what was so in the early 1970s they become a corporation, so no longer a partnership. In the 80s, they in a business downturn, they get sold to American Express and become part of a financial conglomerate before being spun off again as an independent entity, but which was a public corporation that had no sort of family basis at its core any longer.
Thank you for that. We do have a question from the audience, but it does regard the religious and cultural background for Jewish people. And Eric, I know your background is mainly in economics, so I do want to acknowledge the question here. But if at any point, Eric, you feel like your expertise ends for this question, I want to flag for the audience as well that on Monday, October 23rd at 7 p.m., our Jewish consultant, Pamela Nadal, will be coming on another talk back with us, and she would be extremely well positioned to answer this question. So if you would like to tune back in then. But I'm going to read the question out loud, and I'm going to share a little bit of what I think. And Eric, if you also want to jump in, that would be great. Sure. The question is, would there have been a religious or cultural dissonance that might have been typical for a Jewish person owning enslaved people, given that freedom from slavery is an important part of Jewish history, for example, Passover and the Exodus? My thought about this with what I had known from researching the dramaturgy of this play is that the Jewish religion changed a lot for immigrants when they arrived to the United States. The emphasis on religious practice, evolved given the demands of the material culture of the United States. So it is possible that faced with a different culture, there was some evolution in the way the Lehmans thought. And also know that the Lehmans were in very close proximity with the cotton trade because that's how they were making money. And that proximity may have influenced perhaps the way that they thought about this. But Eric, do you have any further contributions for this?
Well, I tend to think of material interests. This is entirely consistent with your answer. I tend to think of material interests as being very influential in the way that people sort of interpret their culture and the way that they lead their lives. And the Jewish people are not unique in having religious traditions that arguably would be incompatible with slavery, although slavery's in the Bible and in the Torah as well. So the official doctrine of the Quaker Church was opposed to slavery, and yet there were people of the Quaker faith who were involved in the slave trade in Newport, Rhode Island, and in other American ports. And so, the religious strictures or doctrines or principles only take us so far. Like plenty of religious figures in the American South interpreted the Bible in ways to sort of justify slavery, and people in the North interpreted the Bible and Christian theology as being fundamentally incompatible with slavery. So I think that yes, these religious ideas are influential, and at the same time, though, people will adapt them and bend them according to their material interests. But perhaps that's my bias as an economist.
Absolutely. And that also makes me think of this idea that I think the normalization of slavery in this era of America was more of an American part of the identity of America in its construction as a young nation, rather than specific to any religious belief that individuals would have held. Right. But again, I absolutely thank our anonymous attendee for this question. We will be diving much more deeply into the Jewish aspect of this play on Monday, October 23rd at 7 p.m. And please tune back in then. Thank you as well, Eric, for engaging with this. And so I think this is kind of edging us towards the theme of the American dream that has been echoing through the play. And so I was wondering, Eric, that Lehman Brothers, a firm founded by immigrants, arguably achieved a kind of American dream, but their success was very much tailored to and shaped by the firm's existence within a capitalist economy. So what are your thoughts about the way that capitalism has shaped contemporary America and the corresponding idea of the American dream?
Well, so let's go back to where Henry Lehman came from. So he came from a small town in Bavaria, and in that small town in Bavaria, it's almost certainly the case that Jewish people were not regarded in any sense of the term as citizens. So they faced extreme limits on their ability to own property. They were prohibited from engaging in certain occupations or professions, or restricted in other cases. They were faced with punitive, like exploitative taxes that others, and fees and other kinds of restrictions that non-Jewish people would not face. So, this is to say nothing of the pogroms that had happened in earlier generations there. So relative to Bavaria, the United States was much freer, and it was a place of opportunity to a much greater extent than any place in Europe, which is not to say that Jews didn't face sort of cultural barriers, but they weren't sort of the same character. There was no sort of formal restriction on the status of Jews in the economy, for the most part. Right. So this was a land of opportunity, and the Lehmans are an example of how talented people could succeed here and take advantage of opportunities here in the United States that were not available to them in the countries that they immigrated from. So I think the concept of the American dream as we understand it now emerged in the mid 20th century. And so I sort of associate it with the notion of like a stable income, home ownership, shared prosperity in the sense of like, the middle class is enjoying a fairly high standard of living. So that was the product of the prosperity of that era. We can think of the 20th century as the American century, and dominated by these very large, very profitable, and very stable corporations that offered excellent jobs, high-paying jobs, and the consumer abundance was everywhere. So Lehman Brothers was established like well before that era, right? And so in a sort of harsher, more volatile period of American capitalism, most Americans are farmers at the time, and their incomes were extremely volatile, right? So crop prices fluctuated, interest rates, monetary conditions were volatile. So if you had a mortgage, on your house or something like that, you face the risk that you might not be able to pay it and could face foreclosure. You had to ship your goods on railroads that might have, charged excessive rates and so on. This is the origin of American populism, the old version of populism, which represents sort of efforts to sort of get those forces under control a little bit and help farmers and people in rural areas have sort of more stable, better incomes. So the Lehman Brothers, they established themselves within this much sort of harsher economic environment, and they're extraordinarily successful, and sort of rise to the very top of the hierarchy of American society. And so I don't know that that the term American dream is appropriate for them. They're successful beyond the wildest imagination of most middle 20th century Americans in terms of their wealth and income and so on. But they are an example of how the institutional environment of the United States is just much more open to and makes available more opportunities to ordinary people, to people without like tremendous resources or official aristocratic titles or something like this. So it's very, very different from Europe in that respect.
Wonderful. And so the Lehman Brothers achieved a really unprecedented level of prosperity and advancement in 21st century America. And yet they did fail ultimately. And I would be really curious to hear if you had a few thoughts about how such a prosperous and advanced firm could be cut down in today's contemporary capitalist economy.
Well, so they were extraordinarily successful and prosperous because they were able to navigate the sort of changing environments in which they operated. So the American economy evolved through many stages. You know, in the late 19th century, it was a period of very rapid industrialization. You know, they saw opportunities in innovative new companies and help those companies to issue securities, right? And they evolved accordingly. And there were many very talented members of the family sort of at the core of its leadership who governed the firm in a way that enabled it to take advantage of those opportunities over time. At a certain point, that apparently stopped, right? So this is true of a lot of firms, family firms. You know, maybe it's that there is no heir apparent within the family who can continue that, who is sufficiently talented and interested in the business to sort of carry it forward into new environments. But for whatever reason, you know, as I mentioned earlier, in the 1970s and 1980s, when the investment banking business changed fundamentally, Lehman Brothers passed into the hands of outsiders who were sort of in a position at the time to lead the firm into the sort of new era of the investment banking business, which was much more about capital and technology, and also about trading or proprietary trading operations. So this is something that caused the firm to grow extraordinarily rapidly after, you know, they were spun off from Shearson Lehman Hutton, right? So they become this powerhouse of investment banking and proprietary trading, one of the most successful, most profitable firms in the industry, on the basis of their incredibly aggressive adaptation to the sort of new world of investment banking, right? So the person who leads the firm, Richard, Dick Fuld, he's a protege of Lou Glucksmann, who is the one who introduced sort of proprietary trading to the firm, sort of against the wishes of the few Lehman family members and the sort of older partners of the firm at the time. So Fuld was incredibly aggressive and incredibly successful, but the business model that all investment banks sort of turned to at the time was one that involved borrowing tremendous amounts of money to make investments in what later became, mortgage-backed securities. And when the housing market tanked, and when it was revealed that the mortgages underlying those securities were less valuable than once believed, the firm was permitted to collapse in one of the most spectacular corporate bankruptcies ever. And I say permitted in the sense that there had been the possibility that the U.S. Treasury and other firms could have bailed them out or sustained them, but political opposition at the time prevented that from happening. So the firm, I think the more succinct answer to your question is Lehman Brothers failed because of the way that they adapted to changes in the investment banking business, right? The business was very volatile. They went all in on, trading operations and highly leveraged bets, and it blew up on them.
This is a great segue to our next audience question, because we have Jean asking, in the 2008 economic downturn, problems were widespread, and why was Lehman Brothers the company that was essentially, so to speak, thrown to the wolves? And I would throw in here, for example, right before Lehman Brothers, the Fed bailed out Bear Stearns. Right after Lehman Brothers, the Fed bailed out AIG, just as a couple of examples that Lehman Brothers was the one firm that was allowed to fail. Why?
It's important to understand the chronology there. So Bear Stearns failed, I think, in March of 2008. And their business model was very similar to Lehman Brothers, but even more so. Right? So it was widely recognized that this is a firm with a tremendous amount of exposure to mortgage-backed securities, mortgage markets, and so on. And their creditors, they're borrowing very short term to make these long-term investments. Their creditors became worried they couldn't receive funding. They went bankrupt, but the Fed and the Treasury stepped in to facilitate an acquisition of that firm by JP Morgan and Company. Okay, and so JP Morgan which I think had their eye on that firm for some time as a competitor they would like to acquire, they were willing to sort of step in and buy the firm under the condition that the potential losses from this massive portfolio of mortgage-backed securities that Bear Stearns had, would be borne by the public, basically by the Treasury. So that was a successful bailout. It prevented the failure of that firm from having any sort of adverse consequences from the rest of the economy for the most part, but it aroused a great deal of opposition. People didn't like the idea of this wealthy, successful investment bank getting bailed out. They had made a bad bet, right? They should absorb those losses. Okay, and so Lehman Brothers was next. Everyone understood they were going to be next, and there's a potential that they could have sort of taken steps to protect themselves from what was going to happen, or at least minimize the losses or the consequences from their eventual failure. But they did the opposite. So Dick Fuld knew that the failure of their firm represented a potentially very significant threat to the economy, and sort of kept it structured in that way for leverage in the ultimate negotiation that was going to happen. But when the negotiation finally did happen, then Treasury Secretary Hank Paulson decided that it was politically untenable to create some kind of transaction like was done for Bear Stearns and have sort of public money backstop the losses that an acquirer of Lehman Brothers would have. So they had some late night conversations. They were very close to getting an acquirer on board, but ultimately the lack of public money doomed the deal. And on a Monday morning in September or October of 2008, it was just announced Lehman Brothers is going bankrupt, right? And so the short answer to the question is they were thrown to the wolves because of political opposition to public money going to bailing out a failing investment bank. But what followed was much worse than anyone anticipated. So the failure of Lehman Brothers was a cataclysm for financial markets globally. Partly it's because their operations were much more extensive and complex than sort of regulators understood at the time, so that the sudden bankruptcy, the sudden seizure of this very large global business had all kinds of adverse consequences for their counterparties and clients all around the world, right? So it's super disruptive and frightening. But more so than that, this was a signal that even a gigantic, very important firm was going to be thrown to the wolves. And that caused the creditors of firms like Lehman Brothers and Bear Stearns to become deeply, deeply concerned. So that was a traumatic event in financial markets. It caused a very, very rapid response in stock prices and something like a generalized financial panic. Okay, and in response to that, it's not just AIG that was bailed out. The sort of TARP program was announced, and other measures were introduced by the Federal Reserve and the Treasury to provide aid basically to the entire financial system. Right. So Lehman Brothers had the unlucky, the bad luck to be the next bank to fail. If it had been a different one, if Morgan Stanley had failed at that same time, then Lehman Brothers would have been among the firms to have been bailed out with all the others. Right. And so it was just the fact that they were so heavily involved in making bets on mortgage-backed securities, and the fact that they faced this problem much earlier than other firms, that was the reason why they were sort of thrown to the wolves in that respect.
Thank you. And Lehman Brothers collapse, as you say, precipitated a kind of financial panic, and it led to huge consequences. Could you speak a little bit more about some of the government policies that were enacted in the wake, the most important government policies that were enacted in the wake of this financial crisis?
Okay, so there's two categories of them. The first one is, efforts to contain the crisis itself. And so there's a tremendous range of emergency programs created by the Federal Reserve System. They got very creative in finding ways to come to the aid of the financial system and different markets within that system to sort of contain the damage. There's also, as I mentioned earlier, the TARP, which involved the US Treasury providing aid to a very broad range of businesses that needed them. There were other things like aid to the automobile industry and so on. So that's just like putting out fires. The more important change for the long run, though, was the Dodd-Frank Act. So that's an extremely complex, like very, very long series of laws, and aimed partly at restructuring the financial system in a way so that, a repeat of the Lehman Brothers debacle would become less likely. So it includes many things, consumer protection and credit markets that were inspired partly by the fact that there were abuses in mortgage markets that were partly responsible for the problems that arose. But with regard to firms like Lehman Brothers, investment banking firms, they had to make changes in the way that they operated. So proprietary trading by certain types of financial institutions was severely restricted. They also had to change their legal organization, right? So it had to become, they had to structure themselves in a way so that it would be easier for a government regulator to take them over in an emergency, right? So the situation on a Sunday night at the conference room in the New York Federal Reserve with this like super, super complex business where it's not even clear how it can declare bankruptcy and where its assets are and so on, that's not permitted anymore. It has to be organized in a way, it has to have a living will, they're called, so that regulators can sort of take them over if need be. The idea being that the failure of an institution like that should no longer be something that is guaranteed to cause an economic cataclysm because of all the chaos it spreads everywhere. Right. So the Dodd-Frank Act is the main response. It's a super complex, like very, very lengthy piece of legislation or pieces of legislation. But that's a very, very important financial reform. Most historical financial crises tend to be followed by like reforms of one kind or another. So following the Great Depression in the 1930s, you got the creation of the Securities and Exchange Commission and other kinds of regulations put in place, and then as memories of their importance fade, the regulations that get put in place get sort of whittled down a little bit, and then the conditions for another crisis emerge again.
We have another audience question from Dan. Dan is asking, can you discuss the too big to fail concept and the fundamental risks attached to it?
Sure. So too big to fail is a concept, simply put, that an institution is so large, or arguably it's not only about size, like so important or so complex that its failure has unacceptable consequences. And the fact that the failure would have unacceptable consequences puts regulators and the government in a really difficult position that almost certainly means that the too big to fail business is going to get some kind of bailout if it gets into a great deal of trouble. So this is an almost unavoidable problem. So in March of this year, Silicon Valley Bank, a very large commercial bank, got into a great deal of trouble for reasons that go beyond what we need to talk about right now. But the trouble at Silicon Valley Bank spread to other similar banks. And the problem wasn't necessarily that Silicon Valley Bank was so large, although of course it was, but the problem is that it was many other institutions followed the exact same business model. And so the failure of that institution sends a signal about the likelihood of failures at other very similar institutions, right? So it's extremely difficult to avoid this problem. Once institutions become important or large enough, their failure is going to have very serious consequences. So I think the best we can do as a society is write down rules for how bailouts are done that ensure that they're done in a way that protects the interest of the public and doesn't involve like giant windfalls for the owners and maybe creditors of those failing businesses.
Thank you. I have another audience question from Andrew, and I'm not sure if you would know the answer to this question, but let's try it. Why did the actual Lehmans of the Lehman family end up leaving the business of the Lehman Brothers, and where might they be today?
So I don't I don't know. You know, there's some prominent members of the family got into politics, got into art collecting, got into philanthropy, and so on. Not everyone. I cannot answer that in super specific detail, but I'll say that, you know, this is a problem in family businesses. It's not always the case that the talented, you know, children, offspring, want to carry on the business, right? They don't necessarily always want to do that. That there's abundant. Not everyone is sort of meant to be an investment banker, and especially if you have this enormous fortune anyway, and your interest is in art or something like that, it makes perfect sense to, you know, move into other things and have someone else, some professional get hired to take over the business. So I think that's probably the basic explanation. There could be more to it with the Lehman family, but I don't actually know.
Yeah, and my other thought hearing that too is also to what you had said earlier about how culture had changed in America, moving from family-owned businesses away from that. It probably became more socially acceptable to actually tell your parents that you don't want to continue in the field that they were in.
Right. Yeah. So whereas, exactly. The newly arrived immigrant, you're gonna do what your brother, who paid for your voyage across the Atlantic at great personal cost, you're gonna do what he's gonna do. You know, and they operated together as a little democracy where they voted on things, but clearly, like, going off on your own is not an option. Your family obligations are too strong. Whereas, you know, modern families are maybe not necessarily like that to the same extent. That's probably part of the story as well. Sure.
Yeah, absolutely. I'm going to invite the audience with any final questions. Please put them in chat. I am about to come to the end of my list of questions, but of course, if you have any final questions from you, we would love to be able to answer them before we wrap up. But Eric, I was thinking that Timeline has been marketing the play as, and I'm going to quote, the quintessential story of Western capitalism told through the lens of one immigrant family. Knowing what you know about American business history, do you feel like there is actually a connection between the story of the Lehman Brothers, both as people and as a firm, and the idea of Western capitalism? Or would you push back a little on that?
Lehman Brothers, I think, was shaped by American capitalism as much as anything else. They're an example, as I said earlier, of an extremely successful firm that was in the right place at the right time to take advantage and had the talents and the wherewithal to actually take advantage of the opportunities that presented themselves. So American capitalism in the 19th century is a viciously competitive, very, very harsh environment, you know, involving the produce of the labor of enslaved people, right, in some cases, and they sort of find their way through it. It's extremely volatile, and you could sort of view the end of Lehman Brothers as a setting in which, like, they, in the end, failed to successfully adapt to the way that American capitalism had adapted, and the economic system that enabled them to thrive so much ultimately crushed them. So it is a very American story, the story of American capitalism. As I said at the outset, though, it's a very rarefied, atypical story in the sense that they were so successful, in the sense that they were in a relatively narrow sector of the American economy, doing things that were not sort of typical of what most Americans were doing at different times. So with that caveat in mind, I think I agree with your statement.
Yeah. And we have another question from Daniel, who says that since the failure and bailout of Silicon Valley Bank, a supposedly highly sophisticated institution with wealthy, sophisticated depositors, will all banks in the US always be bailed out, and will their depositors be made whole?
Silicon Valley Bank represents a really bad set of circumstances. So in theory, the problem that Silicon Valley Bank posed specifically, a lot of us thought had been solved through deposit insurance. So in the Great Depression, you know, basically the central part of that story, the reason the downturn became the Depression, was the banking system failed entirely. So 9,000 banks closed. It was a banking holocaust. When when reformers in the New Deal wanted to design a program to sort of prevent the repetition of that, they created the Federal Deposit Insurance Corporation that insures deposits. And the nice thing about deposit insurance is that if you have an insured deposit, you have no reason to run on a bank, and therefore a bank with insured deposits is unlikely to face runs. In exchange for that insurance, we make banks pay for it. And we also regulate what they can do, right? So they're under the jurisdiction of regulators that make sure they don't take too many risks with, essentially the deposits guaranteed by the public. So one of the problems with Silicon Valley Bank is their deposits were mostly not insured. Their specific business model was they attracted gigantic sums of money, as much as $1 billion or more in a single account, from tech entrepreneurs and venture capital firms and tech firms themselves and so on. So the dynamic of depositors who face risks if the bank fails sort of reemerged, right? And they did become concerned when the sort of bad securities investments made by Silicon Valley Bank started to suffer great losses, and they started to run on the bank and created this tremendous problem, and the bank had to be sort of taken over by regulators and then sold. So it's a hard problem, and it's one that's compounded by the fact that we have these truly gigantic firms like Bank of America and JP Morgan Chase and so on that everyone knows are so large they are absolutely too big to fail, and they're therefore a safe place to put your money. So the problem is that when there's turmoil in the banking system, there's this great temptation for everyone to just move your money to one of these mega banks that's absolutely safe, right? So there are issues with the sort of business model of Silicon Valley Bank and with the banking structure as a whole. One thing I'll say though is, Silicon Valley Bank was tightly regulated and supervised, and should have been warned by regulators about its sort of very precarious situation. I think in a system where bank regulators are a little bit more aggressive and empowered to actually take strong action when they see a potential problem, that I'm more optimistic something like that can be avoided. And indeed, the Silicon Valley Bank problem, it did spread to many other similar banks, but thousands of banks in the US were not horribly affected by that. So hopefully it's a problem that can be contained.
Great, thank you. And we have one more answer from an anonymous attendee who is wondering, and if there's anything about the actual history of the Lehman Brothers that was left out of the play that you would have included. And I do want to caveat for the listeners that Eric has listened to the audiobook of the play, but not actually seen the production of it yet. But even with the slightly different version that of the play, Eric, do you have any thoughts about how this play approaches poetic license?
Well, so, and this is getting into artistic choices that I feel utterly unqualified to really make judgments about here. But to me, the most significant thing about Lehman Brothers was the fact that it failed so spectacularly, and its failure nearly brought the entire global financial system into a collapse. And unfortunately, that's something that does not have a very direct connection to the Lehman family origins of the firm. The Lehmans, built this edifice, built this ship or whatever, but it was being piloted and owned by someone else much later when it got into that trouble. So I thought it was beautifully written, the novel that I read, and I loved learning about the family dynamics and problems of succession and disputes about how to handle different situations in the family. But at the same time, I feel like I would have emphasized more the second half of the 20th century and the events that led up to exactly what happened. And it would have meant that the play's last act or whatever would not be so focused on Lehman family members, but on the personalities who were running the firm at the time. And the drama continues; it's just no longer a family drama. So that's my judgment about the play. I wish it were a little bit more about 2008, which I think ultimately is what makes the Lehman Brothers story so important.
100%. And just to wrap us up, Eric, I was wondering what you thought about if it would ever be possible for a country like America to move past capitalism into a different kind of economic system.
Okay. Well, so I mean, Americans seemed like very firmly committed, not necessarily to capitalism per se, but to the institutional foundations of capitalism. So things like, property rights and so on. The terms of the Constitution is very clear about this, and that's less compatible with really strong alternatives. So maybe one day you can imagine the U.S. adopting a system that's more like the Scandinavian economic model, where you have higher taxes and stronger social safety net, a greater role of the state in the economy, but who knows. So one thing I'll mention though, in times of crisis, we have actually modified American capitalism pretty heavily. So the best example of this that I know is in the wake of the Great Depression, when the Roosevelt administration enacted all these reforms known as the New Deal. These were profound modifications of American capitalism. It like permanently altered capitalism in many, many significant ways that made a lot of people's lives better, from establishing the Social Security program to like regulating the financial system better, and on and on and on and on. Not all of it was necessarily ideally designed, and some of it might have even been counterproductive, but as a whole, that was a big reform of American capitalism. So we can move from something like laissez-faire to something kind of like having a social safety net and a stronger role for the state of protecting people and so on, and we shouldn't forget that. But I think it's at the same time, it's important to remember that among the alternatives to liberal capitalism are things like, the ones I've been mentioning, like the Scandinavian model or the New Deal system on the one hand, but there's other alternatives too, right? So if you go back to the example of the 1930s, the Great Depression saw the rise of fascism in Germany and Spain and Italy. And so they also sort of, in a way, reformed their systems and moved away from the liberal capitalism they had before, but in exactly the opposite direction, in a way that was just much worse in every possible respect, right? And so in a way, we're sort of lucky to have avoided that here, at least so far. But it's not obvious that the danger of something like that happening here is really gone.
Absolutely. And with that, we are at the end of our time here. But Eric, it was so wonderful to have you with us and for you to share your insight and expertise with us. And I want to thank the rest of the audience as well for joining us on your Sunday evening. A reminder that we do have another talkback session with Pamela Nadal, the Jewish scholar, on Monday, October 23rd at 7 p.m. If you're able to make it, we'd love to have you join us as well. Thank you so much again for coming up, and I'm wishing you the best rest of your evenings.
Thanks, everybody.